Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, there's been a lot of talk recently about a recession. The technical definition or rule of thumb of a recession is 2 consecutive quarters of negative or declining GDP. That is gross domestic product, which is basically economic output of our country. We've had this year in the U.S. In the first quarter, we saw a 1.6% decline. And in the most recent reading for the second quarter, we saw a decline of 0.9%. So that's 2 consecutive quarters. Looks like we're in a recession.
Well, Steve, I mean, not to complicate matters, but the second quarter reading of negative 0.9, that's the advance estimate of second quarter GDP. A revised GDP number is due out on August 25th, and that number is going to be using what's called complete data for its reading of GDP. So
Perfect.
Perfect. So the GDP reading and the story might change somewhat, and I'm not saying that second quarter GDP is going to flip to positive, but it will be adjusted, so stay tuned for that. Additionally, the NBER, which is the National Bureau of Economic Research, says that a true recession must factor in various indicators, such as employment, personal income levels, industrial production, as well as GDP growth that you mentioned earlier. So it's more than simply 2 negative quarters of GDP in their eyes. They account for a variety of factors before declaring an official recession.
So it's not as easy as I made it then, is what you're saying.
It's rule of thumbs usually are rule of thumbs for a reason.
So regardless, Travis, we always say markets are forward-looking mechanisms. With the difficult markets we've had or we've seen here in 2022, actually, they front-run potential recessions as the market looks forward to anticipate a future recession, right?
Yeah, I mean, that's correct, Steve. And as you can see from the chart on your screen, periods prior to recessions are generally where we start to feel the pain in equity markets as they look forward, pricing in a potential future downturn. However, still looking at the chart and moving over to the right, the returns for the 1 year and 3 year following a recession, vast majority of the time, those returns are positive and significantly so.
Yeah, so Travis, it is the same story that we tell people. Put yourself in a position to weather these economic storms while maintaining that long-term focus, which is normally a recipe for investor success, isn't it?
Yeah, that's true, Steve. And, you know, it's best to plan for your plan, not going according to plan.
That's easy to say.
Markets are always going to surprise us, and we like to advise clients to leave room for error in their portfolio. A buffer, as we've referred to it in previous videos, that you can be comfortable with, that's going to help insulate you from making poor decisions during times of potential recessions or potential, market stress. In fact, if you approach planning this way, recessions, market drawdowns become opportunities to deploy capital while prices are low rather than threats to your financial success.
Can't agree more, Travis. It's been great. I look forward to it next week.
Look forward to it as well.